Today we are going to learn about bond valuation and bond risk. So this is the contents of this material: bond valuation process, explaining bond price movements, sensitivity of bond prices to interest rate movements, bond investment strategies, and valuation risk of international bonds. Okay, the objectives of bond valuation is the pricing bond, interest rate sensitivity, and investment strategies. So basically, this material today is to explain the methodologies behind bond pricing and also to understand the mechanics of valuation, yeah, for making an investment decisions. And actually, bond valuation involves discounting future cash flow to their present value. Well, let me put this way, okay? So, uh, what is the explanation on having the discounting of future cash flow? So, when I draw a line of the time diagram here, for example, if we want to buy here in our timeline, yeah. So this is time 0, time 1, time. Well, I will make an example of time 3. So it means that this is the third year for investing a bond. And here, when this is the time when we buy the bond, buying bond. And by having bond, actually we will receive coupon, yeah. And also we will have again our principal value, which is, we call it with par value. So all the benefit that we have from bond here, this is the future cash flow. Okay, so these are the benefit here. We need to make an discounting. We have to discount it, yeah. I mean, this is the amount of the benefit on having bond, and this is the price that we have to pay for this benefit. Now, the benchmark, whether you are going to buy that bond or not, we need to discount it, all these benefits, into our present time. So here, okay. But I will go back here again. So this is the how do I say that? You know that on time value of money, we have learned about future value, which is equal with PV 1 plus I over minus N. Okay, so the present value itself will be FV 1 plus I. Oh, I'm sorry, this should be plus and here is minus. Now, all these things, the C, this 3C and par is our future value, and we need to discount it back one by one so that we can have it as the value of the bond, and then we compare it with the price. Okay, now the variable inside this equation, beside only the future cash flow, it's also the interest rate over here and also the maturity time. So that's why the objective of bond valuation for the next thing is the interest rate sensitivity. So whenever the bond has a longer maturity time, it will be more sensitive to interest rate fluctuations. And also coupon will affect a bond price sensitivity. So if the coupon has a higher value, then of course the value also will be higher, and the price will be more expensive. Okay, and the third one is the investment strategies. These strategies including passive, selective and specialized approaches. So each strategy has its own risk and return profile. Well, this should be suited for different investor. Like we know that investor has three kind of type. One is the risk seeker. Yes, risk seeker, neutral, and here is the risk averse. So the strategy should comply with this type of investors. Okay, so this is the process of the present value in narrative descriptions. I will go to the next slide. Now we are going to learn about how to evaluate a bond. Let me give you an example here. Example. Okay, we have a par value of say $1,000, and we have a coupon of 5%, and then we have a this is say annually, yeah, annually. So basically there are two ways on having a coupon. Some offering, no, there are two kind of an offering of coupon. One first is the annually coupon, second of all second annually. Okay, here, yeah, coupon, there are two way, one annually giving, and second of all is semi-annually. Okay, now I give you first the annually, and then okay, then we have the factor, the discount factor of this bond I is 6%. Okay, so I is the, okay, remember again here, well, let me put it again here, that when we are going to discounting a future cash flow, so this way, yeah, the future value here is the benefit of the bond, like coupon and par, while the N here, the N is the maturity time, or where the bond will be ended, and the I here is the discount factor. Well, in the terminology of bond, the discounted factor here we call it as yield, yeah, or yield to maturity. Okay, learn about the yield. There is yield, daily yield, or YTC yield, current yield, and there is also yield to maturity. Yield to maturity means that is the forecasting on the average of the discounting factor or the yield during the time from the beginning until the end of the bond period. All right, so I change here the I as the discounted factor with symbol of gamma. Yeah, that is the yield. Sometimes Y, sometimes gamma. Okay, let me refine the symbol here. So now, okay, what is the value of bond when the price here is say 980 price, or P, yeah, dollar. Okay. If all right, now we answer this. First of all, you have to make I want to explain first, or for not having a bond equation, but first from the logic, and starting from this logic, then the equation will be defined after that. Okay, so let me put a diagram line here, 1, 2, and 3. this is 0. Okay, let me find it again. Oh. So what we have here on our recent time here, there is the price and also the valuation of bond. Yeah, 980 here. So now we have to think about what is all the benefits in the future, and when all that benefit, this we see the value of the money in our time, which is we call that with the discounted value of all the benefits, and we compare it with the P. Yeah, if the benefits bigger than the price, then you should buy that. But if it is lower, the value is lower than the price, no, that's not worth it to buy. Yeah, so that's the simple way on how I can explain. Well, see here now. Let's see the 5% of the rate of the coupon here in the currency value will be 5% of the par. 5% of par, 5% of 1,000, it is $50. Okay, so because this is an annually given, I put here the C, all the C's here, 50, 50, 50 until the maturity time here. Maturity time. Okay, and also we will receive the principal value or the par here, 1,000. Now then you need to discount it, this discounted to the present time, this also present time, this also to present time. Okay, so if I put it here as PV1, PV2, PV3, all of this will be the bond valuation or the value of bond. Okay, now V1. Oh, sorry. Okay, now PV1. What is PV1? PV1 here, the FV of this is the 50. So 50 put here, and 1 plus I. What is the I? 6%. Oh yeah, okay. What is the period of time from 1 to 0? It's 1, right? So minus 1 over here. And that is, let me count it first. It is 47.169, or we round it up, 17. And then next is PV2, 50, 1 plus 6% minus here, yeah, 1, 2. So it is 2. Now that will give you 44.499. I will round it up to 50. And next is PV3. So PV3, there are two amount here, 50 plus 1,000. So 50 plus 1,000 times the discounting factor 1 plus 6% minus 3, of course. Okay, so then it will be 934.496. So I run it up to 50. Then we add it all. Then this will be all PV total or value of bond here, yeah. Okay, so that is, and that is 1,026.136. I round it up to 14. Okay, so this is the value of having all these benefits, yeah. And we see here that when we compare it with price, so P price is 980, so it should be sorry, B is 980 compared with fee B is 1026.14. So the price is lower than the value. So by buying with this value, we will have benefit for this value. So that's why this what we call it with a discount bond. Yeah, this value, the bond value here, or we call that as intrinsic value also. Yeah, because the intrinsic value here higher than the price, then we call it as a discount bond. Okay. All right. Now, from this logic on having a calculation of the all the benefit of the bond into the discounted value or intrinsic value we say here, from all the analysis here, that's why there is an equation is formed. Yeah, equation of bond valuation. If you see the formula of bond is actually, let me go to the other slide. So from our example there, we know that if I go back again to what is the valuation on those 3 coupons and par, I can say that this is PV1 if I describe it in this way. Yeah, this is a coupon times 1 plus I yield minus 1 plus C 1 plus yield minus 2, and then for PV3 C, let me break it down. Yeah, sorry, this should be yield minus 3 with par 1 plus yield minus 3, correct? Remember that we have C plus P, well, 1050, yeah, like this before. Okay, and I will break down into here. Fine. So we have 3 CCs over here. So this is the sum of all C, and then this will be 1 plus yield minus N, where N is starting from 1 to 3, and par, oh here par, yeah, par 1 plus gamma yield power minus 3. So this is the real formula of the bond, and since it's not only 3 that the maturity time will be, then the general equation for bond, general bond equation is value of bond and 1 C 1 plus yield minus N plus par 1 plus gamma minus N. So this is actually the general equation for bond. Yeah, T equal with 1. Okay, so this is T, yeah, minus T time. So time is running from 1 to N. Okay, well, let me refine it. Sorry for not very clean writing over here. Okay, T and T. So this is the time running from 1 to n. Okay, now you see here, we start from the simple logic of analysis. Then from there, then the equation can be formed. All right. So another simplification on this equation, we can say also that phi, yeah, so we will use the sum of the C over here with annuity equation using annuity logic on time value of money. Now I need you to go back again to your last semester course, which is financial management. We had already explained that about the time value of money, and there is also an annuity equation for time value of money, which give a cash flow that is periodically given and also has the same consistent amount. Yeah, so for this sum of this, it can be this is equal with C times 1 minus 1 plus yield minus n over yield plus par 1 plus n. Okay, now it's your turn to use the equation, the example that I had given it to you using this formula. Okay, task redo the previous example with the above equation. So you need to use this. Okay, this one you don't have to, because it is the same with what I've done before, right? So with the annuity equation. Okay, this is another example that you need to redo it again. So this will be your second task to do beside the previous one, using both way, yeah, both way, the first way and using annuity way. Okay, number 2 task. This is the second task. Oh yeah, let's change the years to maturity time here. 5. Now, semi-annual bond valuation. This is actually, if I refer to my previous example, the timeline will be, remember our first one, yeah? 1, 2, 3. So it said that the coupon is 5% annually. So if it is semi-annual bond valuation, it means that the coupon will be given per semester. So then that's a year divided with 2, 5 over 2%, semi-annual, or 2.5%. And how we picturize this in the flow chart, time diagram here, then it will be like this. So the period here will be 6. So this will be 1, 2, 3, 4, 5, 6, correct? Because it is in semesters now, 6 semesters, or semi-annually. So again, go back again to the previous one. Now, because this is already more than 5 time periodic, so you just use the second equation, yeah, using the annuity value, annuity equation. Okay, so that will be your third task. All right. Now, while you read this by your own, we go to here. Coupon rate, required return, and bond price. So all the variable here will give you the character or the type of bond. First of all is discount bond. This bond selling below par value, and this occur when the required rate of return is higher than the coupon rate. So the yield here is higher than the coupon rate, and the price is below the par. Yeah, just like our previous my previous example, we have price of 980 and par is 1000, so this is the same. Yeah, so that is also the discount bonds. By not doing the calculation for the value of bond, which we have there 1026 something, we can see that right away from the comparison of price and par, and also the rate of required rate or of return, or the yield to maturity. uh, it should have a bigger value from the coupon, and also the same with my previous example, which is this gives 6% and this 5%. So comparing these two only, well, we can already see that this is a discount bond without having a heavy calculation, just like before. And the premium bond, yeah, the second type of bond, it should be selling above par value, and also the required rate of return is lower than the coupon rate. So the price is bigger than par, and the yield here is smaller than the coupon. Okay, and the third one, par value bond, it is a bond which sells at par value. It also occur when the coupon rate equal the required rate of return. So P par equal par and yield equal to coupon. Now zero coupon bond example means that there is no coupon. So if I make a time diagram again, say that this is an N, yeah, 1, 2, 1, 2, and minus 1, and here is N time. So the coupon is 0, period. So it has only par here, price and par, without coupon whatsoever over here. So yes, it is zero coupon bonds are heavily influenced by the required rate of return. You do it again for zero coupon bond example with my previous example. So that will be your fourth task. Same example, information from the example, but now the coupon is 0%. What will be the bond valuation? Okay. All right. Now the impact of the coupon payments. If the bond offer coupon payments, the price would be higher. You can see later on for your fourth task. Yeah. If you find, if you calculate the par value of the zero coupon bond, it has a very lower, it has a lower value compared with the the valuation of the bond that we had calculated in our first example. Yeah. So by giving a coupon, the price would be higher, but by giving no coupon, that will be lower. Okay. So next is the risk for having a bond. Yeah, there are factors that affecting the bond price here. Now, why this is called with factors affecting the risk-free rate? Because the coupon rate yeah, or the yields of the coupon should be bigger than the risk-free rate. What is the risk-free rate again? Risk-free rate, I have explained it in the class that this is the benchmark rate, the benchmark investment rate. So any of investment could not be lower than the risk-free rate, and this is usually given by the central bank interest rate announcement. So this is actually the interest rate from the central bank. Yeah, this is the risk-free rate. Now that the factors that affecting this is among other things are the inflation expectation, because higher inflation tend to increase the risk-free rate. So the higher the interest rate, the higher also the investment rate, and it will give the investment environment will be not interesting anymore, because that is too high. Okay, now the second factor is economic growth. Strong economic growth often lends to higher risk-free rates. There's also increasing demand for capital drives of in the demand for capital drives up interest rates. Third one, money supply, where the change in the money supply influence also the risk-free rate, because the increasing money supply can temporarily lowering rates but may lead to inflation. Okay, government policy as the last one. Government borrowing will affect the risk-free rate, because increasing borrowing can drive up also the interest rate. Okay, I need you to read more about these things. Yeah, read more by your own, and let's discuss it next week. Okay, for the next slide, I need you to read it by your own, and then we will have discussion on that. Yeah, about factors affecting default risk premium. What is this? What is the default risk? Why is it default risk premium? And also, I need you to understand about the credit crisis in 2008. Yeah, later I will give the link for these two to make more understanding for you. Okay, credit risk. Yeah, all right, I'll see you again next week, and please read the rest of the slides, and we will having a heavy discussion on this too. Okay, thank you. Have a nice day.